Hello, this is session 3.3, which is about earnings management and how the numbers are the numbers, but it depends. So let's get started. You'll find this session in Module 4, which is all about financial reporting fundamentals. So, earnings management and the detecting of accounting abuse. We've talked about how the accrual accounting needs judgment. It needs judgment in order to determine when revenue should be recognized, when it is earned, especially since the revenue recognition principle has changed. And remember that now revenues are a bundle of activities or services that need to be recognized as each one in that bundle is earned. We've also talked about how expenses, the recognition of expenses, need to have good management judgment because expenses are expensed when they're used or consumed in the pursuit of that revenue. And the balance sheet shows assets that have future or potential value, liabilities that are promises to others, and those can have a variety of histories, but we need to make sure that we're telling the story as accurately as possible. So the numbers are the numbers, but here are some potential fraud signals, and this is from Shillett's 7 Accounting Shenanigans, and it's a book full of how to do wrong, so to speak, or how to be a good auditor. So you can record revenue too soon or be of questionable quality, and there are lawsuits in this area and accounting frauds where the recognition of revenue happened when mobile homes were built. They were never sold, but somebody could have bought them, so it was recognized too soon. You can have recording bogus revenue, revenue that never happened, revenue that you made up, willful intent to deceive. That's also known as fraud. You can boost your income with one-time gains. You can say, oh, that there wasn't any impairment there. It really, it recovered. And so you can have a one-time gain that really the evidence may or may not support it. You can shift current period expenses into later periods by keeping them in assets. That keeps your expenses down and your assets but rosy. Or you could shift those expenses into an earlier period as well. So you need to think about when does an expense, when it's used or consumed, and when it still has future or potential value, depending upon whether it should be on the income statement used or has future potential value, balance sheet. You can have failure to record or improperly decrease the liabilities. So you can manage your earnings by keeping things in liabilities rather than taking them over to a revenue account. You can shift your current revenue to a later period by keeping it in that unearned or deferred. You can shift future expenses into the current period through the improper accrual or the one-time charge. In other words, you can misestimate what your expense is. So those are some of the ways. So that means the bottom line, you need responsible managers, accountants, and auditors that have integrity, that you can trust, because if there isn't trust, then the whole financial market system that exists today has no solid underpinnings for telling an accurate or probable story of what happened. So accrual accounting is dependent upon good judgment. So here's some examples. You may or may not remember WorldCom, but WorldCom, the fraud was brazen and easy to spot. The scheme was not complicated. The financial officers took routine maintenance expenses, and they said, oh, they're not an expense to keep things up and running. We're really improving them. We're creating an asset here. So they, instead of putting that $3.9 billion on the income statement as an expense, they put it on the balance sheet as property, plant, and equipment, meaning it had future potential value. So it wasn't routine maintenance. They said it was prolonging the life of the asset. Because it was kept on the balance sheet and not on the income statement, the net income was larger than it really should have been. So, I think I answered to the first part. Explain how capitalizing an item, meaning putting it on the balance sheet instead of putting it on the income statement, expensing it, affects the income statement. Well, it makes the assets larger and the expenses smaller, and if expenses are smaller, then net income is larger. So, what principles were violated? Expense recognition, faithful representation of what is an expense and what is an asset, and the full disclosure of what's really going on. Here's another one. Here we have a company that makes toasters, and they're trying to decide if they should recognize the revenue when the toasters are produced or recognize the revenue when the toasters are delivered. And they're going to look at this over 3 years. So toasters produced 200, 200, and 100 versus toasters delivered 150, 200, 150. In both cases, it's the same amount of toasters over 3 years. It's just you're shopping or picking which year to show the revenue. All right. So if I do it when they're produced, notice that in the first year, my net income is $12,000 because I produced 200. In the second year, it's 12,000, and in the third year, it's 6,000. Overall, it is the same whether I do it when the toasters are produced or when the toasters are shipped or sold. So it's just when do I recognize it. If I do it when it's shipped, the bottom line net income is 9,000, 12,000, and 9,000. Now, why would a manager front load the revenue? Oh, I hear you. Could be their bonus, couldn't they? They're like, I'm only going to be in this position for 1 or 2 years. So I want my bonus, which is dependent upon the revenue and the net income, I want my bonus to be big. So I want to recognize that revenue as soon as I can, as early as I can. And that's why someone might be led astray not to recognize the revenue when it's earned, which is when it's shipped. So notice overall, it's the same. Here's another one. Here we have a company that Cascade has ordered 4,000 brackets from McKay, and they ordered them on December 1st. For $40,000. McKay completed manufacture of the brackets in January and delivered them in February, and McKay received a check for $40,000 in March. So which month should the $40,000 in revenue be recognized? When the order is placed, December, in January, when they manufacture, in February when it's delivered, or in March when the cash check is received. So what do you think? I'm hearing you. Yes. So in February, when the title to the goods passes to the customer and they are no longer on the seller's books. That's when it should be recognized. Why would you say that? Well, it's the contract, and they have separate performance obligations, and that was when it's delivered. Then you know the transaction price, $40,000, and you can allocate that price to the obligation, which is to deliver the brackets, and so then you recognize the revenue that way. Part C. Are there conditions under which the revenue could be recognized in a different month than the month you chose? Yes. And are there several reasons McKay's management might be interested in the timing of the revenue recognition? So, why could it be different from the norm? It could be a special order. It could be these brackets are custom. They're one of a kind. And it could be that the customer has a questionable ability to pay, and if there's a questionable ability to pay, you can't really recognize the sale till it's determined that they are able to pay. Don't send them the goods until you see the money. As far as reasons why the management might be interested, we talked about bonuses. It could also be taxes. If my net income is higher in one year versus another year, or the tax rates are changing from one year to another year, it may be that I want my revenue to be in the year of the lower tax rates. So that has impacts or effects upon managers' judgment of when to recognize that revenue, for good